I've seen this from a lot of analysts lately, is the market has been able to push performance very heavily over the last few years. Performance now is going to be primarily met by strong operations and typically with budget management. How are you able to budget properly to maintain your income and increase it as necessary, but also cap your downside, cap your expenses? Because insurance, taxes, and labor materials are just skyrocketing. Any thoughts there? Any advice there for other operators that they're starting to shift their game plan to shoring up the ship?
Yeah, I mean, I think if you own assets, it's a lot easier to look at those assets and find where there's a little bit of fat, where you could trim and cap your expenses. There's so many different little levers that you need to look at. And that's a real-time monthly sort of evaluation. You could have a seasonal dynamic where you've got to put more money towards X, and then a different season, you could scale back some of that expense. So it's really, again, we could talk for hours on that, but it's a very granular, real-time analysis of expenses. I'm not going to bore you with all the typical stuff, utilities, management, and all that stuff. I would say the biggest thing that operators should be looking at, which I don't believe that many were in the last several years, is I don't think they're doing good diligence up front on your costs. So where insurance costs are unpredictable today, they're all over the board, and they're different from, like we're buying an asset in Louisiana at LSU that we're closing on in 30 days. The insurance being a cat area is insane, and it was almost a deal killer. So don't guess, and make sure you're getting insurance quotes. Make sure you're hiring a professional to do a tax study. We do a tax study on every deal that we buy. We don't just say, gee, let's get on the county website and look at the mill rate and let's just guess. We're not experts in tax analysis, but the national firm that we use, they are. And I'd rather pay a couple $1,000 to ensure that I know my worst case, my best case, and my base case of insurance. So a lot of those things I think are not being diligenced right up front and underwriting for it, as well as CapEx. Guys are just saying, hey, it's an average of 10 grand a door. Well, have you checked, viable vendors today in your market that have validated with us with hard number bids and multiple bids? That's probably my best piece of advice right now in the market that we're in, because we can't afford to be wrong, right? We can't afford, because we're not going to make it up on rent growth, right? We're going to plug in a very conservative number. So I'm not going to get it on rent growth. If I do, great, but I can't depend on that on the front end. I've got to have all my numbers set.
Yeah. That way, if you do get the positive rent growth or about more than expected, it's your LPs are happy with you. Not that you came in a little bit below and they're questioning why the return's lower than expected.
Yeah. And the other thing, I think, expectations of returns. We've all been spoiled, and I've told our investor base, I mean, our portfolio track record is exceptional, but I keep telling them, do not have those expectations going forward. And I feel like that's okay, because we're still in an asset class that's very tax efficient. And, there's other things you can invest in that might be ordinary income rather than long-term cap gains. Are you going to be in the market that's volatile? It's not for everybody. I'm not saying don't invest in the market. I invest in the stock market, but the majority of my wealth is in real estate. So I'm okay saying, hey, if I was, doing an average of 15 IRR in the years past, I'm okay with 13, because, it's still a great asset class, but let's not have unreasonable expectations.
Yeah, that'll be interesting to see how just LPs get because you're educated through experience, through opportunities and all that on, hey, these are what these opportunities should be performing at. So it's almost like from a GP perspective, if you're putting out something lower than that, like it's already harder to raise now, but even though you may be honest, it's going to add some extra headwinds on the raise, and how did they react to that? So it'll definitely be interesting to see how LPs react to that. But at the end of the day, when they go through a few cycles and see it in real time, they'll get it.
Yeah, I mean, the thing that I've been hitting, we've just raised for a couple of projects successfully, knock on wood. And my LP said, well, why are you in this 13, 14 IRR range? I said, I'm in this range because I'm assuming that 4-5 years from now, interest rates will be the same as they are today.
Yeah.
And they say to me, well, that's probably unlikely. They'll probably be a little bit lower. And I say, I agree with you. And if they are, your IRR will be not 13, 14, it'll be 16, 17. Are you okay with that? And they're like, oh yeah, great. Well, so it's an education with our investors saying, we're projecting this because we're not, projecting interest rates will be lower. If they are, that's an arbitrage because cap rates will come down and we'll be able to do better. But let's just be conservative. If all things are equal, we'll be in the lower teens rather than the high teens.